All right, we are live. Let's go live on TikTok and live on Instagram. There we go. Okay. How's everybody doing? Make sure the screen is working correctly. All right. So obviously we have a potential Black Swan event. We're going to go over that. Kind of want to inform everybody what's going on at the moment. We do have a huge potential risk in the short term. Those of you that just jumped on, we're probably going to see the S&P stocks start to recover a bit. I think we have a small recovery, and then before we start to roll over again. This was a pretty sharp sell-off. Japanese Nikkei, basically the Japanese financial system pretty much blew up, and that is leaking into the US. And we're definitely gonna go dive a little deeper. I just wanted to wait for a couple more people to jump on there. We have the VIX soaring to the highest level in about 3 years, right? So we had the VIX jump to overnight 65. I thought I saw it go even higher than that. But this is market turmoil. Everything is selling off at an extreme rate. Yields are down significantly. Let's kind of look at yields. I mean, this was a gigantic gap down. The market is getting crushed. All right, I'm gonna get a couple more minutes before we kind of go over what is happening at the moment. We should have the S&P recover a bit, maybe over the next couple days before we really start to tank. But that VIX, 20 is the big level. The VIX went even higher. Okay, these are the zones for the VIX. The warning zone is above 20 for the VIX, right? Above 20 is the warning zone. We got way above that. We went all the way to the damn pandemic high. So this is very treacherous territory. We're going to see if we can bounce here. And if, a lot of these fears are overblown, it's a deleveraging event. We're facing a deleveraging event for the VIX. We've seen this many times over the decades, 100%. And I know some people are wondering how it happened. It's a combination of fears, geopolitical fears in the Middle East. Is the US going to get pulled into the war? And it's also a giant deleveraging event. It's purely the Japanese market is tanking. Biggest drop in the Nikkei in history in one day. I think they call it the second biggest, but if you go over, the last couple of days, it's probably the biggest jump. This is what's causing everything, though. The Japanese yen is surging versus the dollar. Here's the Japanese yen right here. It is surging, and the Japanese yen never surges. It always drops. And this is what's causing everything. It's always different this time. Have to see where we'll be in about 10 years. We'll see. The Fed might come out and have to, inject liquidity or cut rates at some point. This might cause more deleveraging in the banking sector, definitely in the banking sector. So let's go over that. I think we have enough people where we can talk about this. All right, so let's go over this deleveraging event. Here's what's going on. Basically, Japan has been the place to borrow money, right? So when you look at the dollar this is the dollar versus the Japanese yen right here. Okay, the dollar is always gaining value against the yen. It's been gaining value for a long time. Sometimes it comes down. And what happens here is basically you have, and I'm going to go back to the Nikkei. I'm going to have the Nikkei here. The Japanese currency has been tanking for a long time. This is the Japanese currency. It's just been tanking. And what happens is big investors, big traders, they come in, they borrow money. Remember the US rates right now. Let's kind of draw this out. US rates are at 5.5%. That's the borrowing rate. 5.5%, whatever you want to call it, 5.5%. Japan, it's less than 1%. Okay, it's less than 1% in Japan. Let's call it, as a matter of fact, let's double check. Let me see what the Japanese, let's see what the interest rate is in Japan. It's very low. It's like it might not even be 1%. Japan's interest rate, not even, it's 0.25. I mean, this is ridiculous. It was at 0.1%, bro. 0.1% borrowing rate. Okay. 0.1% for Japan. This is Japan, JPY. Okay, and then this is the US. I'm not going to make it too complicated. I just want you guys to see the difference here. So basically, people are borrowing money, big investors, big firms, whoever they are, they're borrowing money in Japan at 0.1%. Very cheap money. They're borrowing cheap money. What are they doing? They're turning around and buying assets. Or they convert the Japanese yen. They're converting Japanese yen into US dollars so they can collect 5.5%, right, at the money market funds. So you're getting free money in Japan, pretty much, Japanese yen, you're getting free money, and you're converting it and now making a yield of 5%. You're getting free money. You're making money here. They're also buying assets. This is, a large part of the tech trade getting so big, NASDAQ getting so big, NVIDIA getting so big. You can go borrow money for zero in Japan and just go buy a bunch of stocks. And now that the stock market is up so much, those people have made a lot of money. But what did Japan do? They increased their interest rates. Now, keep this in mind. The more that Japan keeps their rates low, it hurts their citizens. Their currency, this is the currency from having such low rates, their currency basically tanks, right? It's worth nothing. Why would you hold Japanese yen when it yields nothing? And then you have a bunch of people borrowing money. You have the Bank of Japan printing money, devaluing the currency even further. So you just get, the value of the Japanese yen goes further. So why not borrow from Japan and then go buy US stocks or even buy the Japanese Nikkei, right? You can go buy the stock market in Japan. So the point here is Japan is saying, look, if we continue to keep these low rates, our citizens are losing buying power. Japan is a net importer of goods. They import goods. The more their currency drops, the more expensive it is for them to buy goods in other countries. They're seeing inflation. Right? Their purchasing power, their citizens' purchasing power is nothing. Their economy is tanking. So Japan said, you know what? We're going to have to increase interest rates. So they hiked rates. And now all those people borrowing at 0.1%, right? Now they're borrowing at 0.25%. Okay. So their interest rates for that carry trade, you've heard of the Japanese carry trade, their interest rate on that trade just jumped. Now they have to pay more interest on the trade. Not only that, but the debt that they took out, the loan they took out just exploded in value. So if you borrowed $1,000, now now you have to pay back 1,100. You have to pay back a lot more money and they're leveraged. Plus your interest is higher. This is what blew up the market. This is exactly what blew up the market. Japanese currency exploded. Whoever borrowed all that money for 0.1% now owes a lot more money. Therefore, they have to deleverage. They have to go ahead and deleverage and start selling all their US stocks. Now, trade has been going on for a long time. This has been going on for years because, interest rates in Japan are so cheap. Therefore, all these gains in the stock market, a lot of the gains in crypto are from borrowed money from Japan. Japan has been the money printer, right? That's where you get free money. Now that money is going up in value in Japan, your debts are bigger. If you borrow that money, your debt is bigger, and now your interest rate is bigger. Now you have to pay back more. So they're going underwater. It's a giant margin call, right? And this is not just Japan. All this borrowed money is in US stocks. It is in global stock market. So now you have the Nikkei dropping to the biggest level in history. And this is causing a huge deleveraging event. People are deleveraging from the stock market. It's triggering other banks in Japan. Banks in Japan are getting triggered, and this could cause a crisis. This definitely could cause a crisis. And at the same time, right? At the same time, we'll come back to this, but that's the Japanese yen. That's exactly what's going on right now. And then you can see the dollar tanking, right? Why is the dollar tanking versus the US? Because the Japanese yen increased interest rates. That makes their currency more valuable, makes the dollar less valuable versus the Japanese yen. So it's tanking. Okay, it is tanking because it's less valuable versus the Japanese yen. Therefore, we're seeing the dollar actually tank too, right? We're getting the US dollar, DXY, finally starting to break down here, right? And this is causing a deleveraging event, giant deleveraging event. Now you have the S&P gapping down. You have NASDAQ gapping down ridiculously. I mean, we're probably going to retest up here somewhere and then sell off again because it is not over yet. A lot of unraveling has to happen here because there's a bunch of leverage and there's a lot of margin calls. It's a global margin call at this point. Okay, global margin call. You have the VIX exploding. Now, the one thing that is performing in the US right now was bonds. They are pulling back, but US bonds are starting to explode because the risk of recession has just risen tremendously. Banks lend money, right? The whole financial system is all about financing. Banks are lending money. If banks are now getting margin called, now they might not have the deposits. Liquidity is about to get sucked out of the system. If there's less liquidity in the system, you can't pay people back. You have to sell assets. Banks are going to be forced to sell their assets, okay, in order to cover the margin calls that people borrowed from them. So the system, the financial system is at risk. I expect the Fed to come in and inject liquidity or cut rates over the next month. They might do it tomorrow. They might do it by Friday. Who knows when they do it? But the Fed is going to have to do something. They don't really want to because they don't want to spike inflation again. And you know, oil's down. So inflation is not really a risk at this point. It's mostly this deleveraging event. Now, here's the bigger issue. If the Fed does cut rates to relieve all the leverage, all the liquidity that is losing from the market is getting sucked. You know, the liquidity in the market is getting sucked out. People are getting margin call. This is a global margin call. Now, there's another issue here. There's a war brewing in the Middle East. You guys have all seen it. It's on the news. And that causes supply chain activity. You know, if the war breaks out and it brings the US, if the US has to come inside of this war, then that basically means supply chains are getting shut down. Oil prices are going to spike, furthering the recession. The Fed over tightened. Yeah, the Fed, you could say the Fed over tightened. It is true. They were waiting for something to break. We were waiting for that too. And now something broke. We thought, hey, something is going to break if the Fed continues this up. But it didn't have to do with the Fed. It had to do with Japan. They tightened interest rates and they broke the global trade. The global carry trade is what they call it. They broke all the leverage. It's just a giant leveraging machine over there in Japan. So now we have a war in the Middle East, all right, that is starting to brew up, starting to pick up. If it does accelerate, you're going to see oil prices start to break. I don't want to see this. I definitely don't want to see this, but oil prices will break out if that is the case, because now you have to increase production of weapons. You have to start moving, right? Oil is going higher if that is the case. That's going to bring the US into recession even further. Gasoline prices go up. Also, you have supply chain disruptions, right? You're going to get Hamas and Hezbollah and Iran in the seas start to blockade stuff. Now you're going to get a supply chain disruption. What's going to cause a bigger slowdown and more inflation? Supply chains are going to be stopped up. This is not good. Okay, this is not good. So you have the Japanese deleveraging event that is causing a global deleveraging event, and you have a potential war. Hopefully the war is not real. Hopefully we can take care of this Japanese deleveraging event over time, but the war is something that might stick around, even longer. We don't know, right? So yeah, that's why everything is crashing. The only good thing here is that the dollar is actually falling, right? Not going higher. So it has to do with Japan. It doesn't have to do with the US necessarily, but we definitely don't want to see oil spike because that is a systemic risk to the actual US economy. And if the US economy goes down, right, unemployment's already climbing. If the US economy really goes down, we just got the ISM services report also. Okay, we just got ISM services. How bad are they? Let's see. The market might be rolling over now after that report. Let me check the ISM. Let's go to SPY. ISM is the service report. We'll see how bad that is. I'm about to check out the ISM over here. More economic data. ISM came in. We can check this together also. We can check this together. Our manufacturing index came in very weak. Where are we at with ISM? Okay, good. Oh my goodness. That is a good sign. The US service sector is not collapsing. Okay, our manufacturing sector is collapsing, but the services is not. We're going to pull this up for you. We're going to pull this up. Let's go ahead and pull up this report that just came out right now. Okay, I'm going to pull this over for you guys over here on TikTok. There we go. So ISM services are important. It's basically supply chains for the service economy, and services are 70% of the economy, right? Consumers spend money. Usually it's on services, not necessarily goods at this point. Now we dropped to a 48. Anything below 50, look at this 50 level. Anything below 50 is a recession. That is recession territory. And we were dropping for a while. If we look at we turn this into an actual Let's turn this into like a, you can't see it that great. We'll go to this. Okay, we'll go to this chart. So once you get below 50, you can see we've been cooling since 2022. We dropped below 50 twice. We got to 48. Not good, because that signals that we're accelerating into recession. Okay, we're accelerating into recession. But we just got that report right now, and it looks like we're not in a dire position. Services jumped again. Remember, GDP is up. GDP is accelerating this quarter from the last quarter. That's a good sign. All right. I bet you the VIX is falling at the moment. When can you start seeing this as breaking news on CNN? Fed has no choice but to cut. I don't know when we see this. We'll see how markets play out. There's a lot of moving parts right now. The Japanese carry trade, the U.S. recession, the global, a war in the Middle East that might heat up and turn on and shut down supply chains, and energy prices go up. The Fed, if they cut, if they have to cut, they're going to be worried, because if they cut too much, inflation might spike and then come back down. But either way, everything spells recession. Everything spells a slowdown, except for this ISM report. That is good news. Okay, so now we know the service sector, right, is not necessarily slowing. And you can see the different segments here. Employment, 51, that's good. Employment is picking up in the service sector. It was at 46 last month. We're at 51. So the good news here, new orders up. Okay, great. Good news here for the U.S. economy is, yes, the manufacturing sector is slowing down into recession, but services are still strong. Okay, services are still strong. Let's keep that in mind. What else we got for the rest of this week? We don't have nothing big. That was what I was looking for. The ISM report looks like services are strong. Okay, let's move. Let's get back to the charts here. Let's get back to this trade. What's kind of going on here? What's unwinding? Okay. So the S&P jumped on that news, not a recession, right? I bet you the VIX is down. The VIX is falling significantly. Okay, I'm going to go to this chart really quick. Okay, so we have a recovery. Now, where's the resistance? Let's go ahead and answer some questions first. If you guys have some questions, been a while, fear right now. I'm buying while people are in fear right now. This is a great game. If you have cash, it's going to be a pretty good buying opportunity if you do have cash. But a lot of people are down on their positions if they're trading. And they the VIX spike. Typically for the VIX, once you get to 20, that is resistance. Okay, well, Friday we jumped all the way to 27. Or no, we jumped to 29. And then Sunday we jumped to 64, right? Biggest jump since the pandemic. This is the third largest jump in history. Third largest jump in history on the VIX. It is not just about war. This is a combination of war, which means recession, which means higher energy prices. And it's also a deleveraging event over in Japan, which could bust a lot of markets and bust the global financial system, because Japan is the borrowing. It's like a credit card. Japan has been a credit card, just lending money at a low rate, lending money. Now that those rates are up, and now everybody who borrowed on margin in Japan is getting blown up. That's what's happening. Okay, so I don't know. This is not gonna resolve itself in one day. Therefore, if the S&P makes a sharp move to the upside, expect it to roll over. A lot of people are just, probably covering at this point. Let's go to this chart. A lot of people are probably covering. I am long bonds at this point, because if we go into recession, then bonds go higher, right? You heard me talk about that. I was wrong about IWM. Look, small caps got crushed. Small caps want a rate cut. But at this point, recession might be too heavy for the small caps. A recession might just bust too many companies. TLT, on the other hand, yes, it is selling off, but the risk of recession. Now, the reason TLT is coming down is because that ISM came out and it basically reflected no recession. So bonds are going to bid up if recession fears accelerate. They'll still go up. They're still going to go up because the Fed will cut rates. This is about the election. The election is another risk also. The election is another risk on the table, which is what's going to be the regulatory environment, what's going to happen geopolitically, whether it's Trump or Kamala Harris. So you're right. It is not just about the election. It is a deleveraging event. Okay. It is war. It is higher energy prices, possible stagflation, which is the worst environment. And it is, geopolitical risk. The market cannot predict the next 30 days. The VIX predicts the next 30 days. That's what it prices off. What's going to happen over the next 30 days. And the VIX is saying we cannot speculate what happens in the next 30 days. So protection is being bought up. what should you buy right now? I will tell you what I did. Okay. Now, this is not financial advice, but as soon as we opened, I bought puts on the VXX. I bought VXX puts because the VIX is way too elevated. Okay, it's way too elevated. I mean, it already dropped significantly, so I'm probably up on those puts. I don't even know what I'm up on, but I have the puts all the way to October. Usually October is the bear market killer. I'm hoping this is the peak in the VIX. I could be wrong. Great. But other than that, you just let things resolve itself. You want to see what happens here. Let things resolve itself. I still think Bitcoin's a great trade if you want to hold it. But I'm more worried about that Japanese Nikkei, the Japanese deleveraging. That's what I'm more worried about. War? Who knows? You can see what happens in the war. We can see the escalation, but you cannot see the companies and the banks that are breaking inside the system. You cannot see that. We don't have eyes there, which is why we want blockchain technology so we can actually track that. But we don't have eyes on that trade, right? As long as we see the Japanese yen, this is the Japanese yen versus the dollar. Actually, let's just go to the yen. As long as we see the yen continue to spike, this is going to crush a lot of borrowers. Whoever's borrowing from Japan, this is crushing them. Their debts are rising. Literally, their debts just jumped. Let's see what this percent is here. We're going to give an estimate. We don't know what it is. So if it jumped 15%, just think of if you took out a loan of, and these are big traders, they're taking out billions, right? Hundreds of millions, billions. Well, 10% of 100 million is what? 10 million. So they're underwater significantly. Now they have to pay the interest on that loan. So they're getting crushed. The more the Japanese yen goes up, the worse. If the Fed cuts rates, guess what? The Japanese yen goes higher. So that's going to cause more havoc. So we just don't know what the hell is going to happen. More than likely, I think the Fed actually increases liquidity, okay, into the market. Fed net liquidity, that's what I'm looking for. They might have to re-liquefy a couple banks who go under. Let's see where Fed net liquidity is. I'm going to turn this on really quick, put it on the daily chart. And this is Fed net liquidity. So I'll be looking for this. Let's take this off. I'll be looking to see what this does over the next 5 days. Do we get Fed coming in and increasing liquidity? Do they cut rates? I don't think they cut rates, but if we start seeing bank failures like we did in 2023, then the Fed's going to have to increase liquidity to backstop the bank failures, right? To backstop the deposits. We're not there yet, but it's anything can happen over the next hour, over the next couple days. So I'm looking for the Fed has to make a move though. The Fed has to make the move at some point, whether they cut rates, whether they increase liquidity. I think some firms are pricing in a big rate cut, like a 75 basis point rate cut because of this carry trade that is basically breaking in the market. Okay. I'm trying to get CNBC up. Something's wrong though. It's not streaming. Let me try it again. I might not be able to get it live for the YouTube, but man, I don't know why it is not. What do they do? Shut me out? Let's try this again. Okay, there we go. We're signed in.
Hearing some other names as well.
All right.
That are down, but certainly it's got to be.
All right, I'm gonna put CNBC here in the left-hand corner as we watch this, and then I'll answer some questions.
64% of its average daily volume already.
You guys should be able to hear it on YouTube.
5 minutes of trading, so that gives you an idea of the volume challenges that these platforms will be facing today, as so many people are so active on a summer day.
Yeah. And I know it's August, although we do get days like the
Trading to set when markets are trading.
Mr.
has been propelled in 1.5%, or being in order for you to trade down the top
$1 billion. That would be ahead of street expectations.
All right, so they're going to kind of talk about the Nikkei getting smashed here.
Its worst day since 1987's Black Monday. A lot of that having to do with what we call the yen carry trade. We've talked in the last couple of weeks about the significant move up in the yen as a result of a move up in interest rates. And perhaps we underestimated just how much money was at stake here. Dom Chu, you've been tracking all this action. Let me let you take it from there.
Yes, sir, David. So the overnight hours in Asia saw the first chance for the world to really react, right? The first time zones to react to the Friday jobs, really the sell-off. So that epicenter, as you point out, is the Nikkei in Japan. In Tokyo, the benchmark Nikkei 225 dropping by, you can see they're over 12% by the time the market closed. Again, the worst day for the Japanese market, going all the way, as David mentioned, to that Black Monday time frame.
Somebody asked, what is the yen carry trade? I just explained it on YouTube. You can go back on YouTube. Basically, people are borrowing from Japan. I'm going to quickly say it. People borrow from Japan. That's why the Nikkei is blowing up, the Japanese Nikkei. They've been borrowing from Japan at zero interest rates, basically. And Japan just increased their interest rates. So it's blowing up all that leverage. They're leveraging from Japan, converting the Japanese yen into US dollars, buying US stocks. And now that Japan increased their interest rates, the loan is, their debts are bigger. Their debts just increased overnight significantly, and the interest on it increased overnight. So they have to sell. They have to deleverage to pay back the loans. That's what's happening. That's basically it. I mean, you can go into detail, but basically it's a deleveraging event, kind of like we saw in 1987. That's what we're comparing it to today.
87. It also ended up, by the way, being the worst one-day point drop in Nikkei history, down 4,451. And it washed away all the gains that the Nikkei has seen so far this year-to-date period. Now, a big focal point for traders in both Asia and here in the U.S. has been, to David's point, what's going on with the currency itself. So the yen has been on a weakening trend for, you can see, most of the year, going up for the value of the U.S. dollar, which means, again, quoted directly, meaning that we are looking at how much the yen versus the dollar could buy. So the higher the number, the stronger the dollar and the weaker the yen. As you can see, it's been a regime of stronger dollars and weaker yen. When the market became more risk averse in just the last couple of weeks and maybe even months at this point, we've seen a move lower sharply in the value of the dollar and strengthening the yen. Remember, people sell yen as a way to finance transactions in order to buy certain assets. They have to close them back out in terms of trades. So this move in the yen and moves by the Bank of Japan to intervene in markets earlier this year to prop up the value of the currency have led to that big drop in the value of the dollar and strengthen the yen. As for the ripple effects, they're being felt all over the region as part of that global stock market sell-off. If you take a look at some of the hardest hit Asian indices, markets in South Korea, the Kospi, they're down 9%. They triggered trading pauses, circuit breakers, to help stem downside volatility in South Korea. The Kospi index, again, lower by nearly 9%. Weakness in computer chip stocks helped propel the Taiwan weighted index lower by over 8%. You can kind of see here, 8.5%. And then also the Singapore Straits Time Index falling by about 4%. If you want to believe this, the relative outperformer was actually the Shanghai Composite in mainland China, which only fell by about 1.5%. But Melissa, overall, it has been, at least for today, that weakness in Japan and the Nikkei that's been a huge story that's driving some of the downside sentiment, not just here in the U.S., but around the world, Melissa.
And many would say, Don, that the unwind of the carry trade is one of the major forces behind the market sell-off that we've seen. And so a key question, especially as we stare at losses in today's session, is has that deleveraging been complete? Are we near the end of that sort of deleveraging process? And if the answer is no, then it's going to be continued risk-off scenario here as we see that the yen basically reverse the course that it's been on for the entire year.
Sure, Melissa, and to your point about the interconnectedness of all those markets and themes, right? One of the propellers of that Nikkei trade could arguably have been, and maybe even less than arguably, almost as a matter of fact, the weakening of the yen when it comes to companies in Japan that make most of their money exporting stuff to the rest of the world. That weaker currency actually helps propel the value and the profits for some of those Japanese companies. So you can say the Nikkei 225 has been propelled in many ways by the strength of the dollar and the weakness of the yen. And all of a sudden, when you have this buying back of the yen strengthening there, that incrementally hurts the profits of those companies as well. So it speaks to this notion that it's not just a general risk aversion trade, Melissa, but yes, many of those technical currency dynamics are certainly part of that bigger picture story as well.
So what he's saying is that the reason the Bank of Japan hiked rates is to strengthen their buying power, their global trade buying power, right? If they're importers, they're net importers of goods, Japan is. So if their currency is too weak, then as their currency loses value against the dollar and other currencies, well, it costs more. You're losing buying power. It's inflationary, and you're losing buying power. Their citizens cannot, if a dinner was $20, it's now 21, now it's 22, now it's 23. Well, not bucks, but yen, right? So they're losing buying power and their citizens are collapsing. I mean, in general, economically, they're collapsing. The companies are losing buying power. So they're increasing rates to get the currency strong again. Therefore, it's cheaper to improve the power of their currency and their economy. But, you never know what can happen. What do? They end up breaking all the leverage. So Japan is breaking all the leverage that has been building up for years, and it's causing a global margin call at this point.
Dom, thanks. Dom Chu.
So where is this going? Okay, yeah. Let me see where is this headed? We don't know. The truth is we just don't know where this is headed at the moment. Central banks, I guarantee right now, are all speaking to each other, trying to figure out, okay, how do we stop this deleveraging event and get things down? Okay. How do we get things down? So it is a pure deleveraging event, and we'll find out. Japan is due to a crash. Yeah. Well, they just crashed. I mean, yeah, they just crashed hard. They crashed hard. The Nikkei down, and the Nikkei just erased all the gains that it had made the entire year. It was the hottest market, right? The Nikkei was the hottest market. I'm going to pull this to the side. The Nikkei was the hottest stock market globally for a while, and it was simply because, I mean, all the investors were shorting the U.S. I'm sorry, they were shorting the Japanese yen, and they were buying stocks. That's all they were doing. It's like borrowing dollars. Imagine if the U.S. dollar, if you're here in the U.S., the dollar interest rates, it costs maybe, dude, it's not like right now rates are at 5%. Imagine if you could borrow for 0.1. They're borrowing for 0.1%, almost zero. And then they're buying stocks. They're buying assets, right? Well, now that they're hiking rates, that trade doesn't work anymore. They can probably still do it, but they're not going to leverage when, they probably were chasing the AI trade in the US. Everybody wants US stocks. And so now that bubble has popped, now that the NASDAQ is down, we're starting to see the unraveling or the deleveraging event. Where is it headed? I don't know. We'll just, keep our eyes open to see what happens. But my guess is there's going to be, there's other systemic risk going on. And then you have the war also. So there's people deleveraging just because they're afraid of the war. I'll tell you this, October is usually the bear market killer. Usually October is the bottom. What do I look for in a company before buying? Pure revenue growth. Number one. Number two, they don't have to be profitable yet. Depends where they're at. And if you're talking fundamentally, I mean, they have to have a use case, right? The company has to have a use case at this point. So you do have tech stocks. I mean, the AI trade, the narrative is AI. So that's one trade, but everybody's chasing it. That's deflating at the moment. But the AI, CapEx from AI, as in the big spenders, Amazon, Apple, Meta, Microsoft, they're all spending hundreds of billions on, materials, or well, not materials, but they're spending hundreds of billions to generate AI, which means data centers, electricity, copper, right? So those are other plays you could look into: copper, electricity, utilities. I think utilities are up at the moment. And then you have the blockchain narrative. You have the electric vehicle, energy storage narrative, which is they need lower rates, right? Anything that has to do with loans, like vehicles, buying cars, nobody buys cars outright. You need lower rates. So at the end of the day, the world wants the Fed to cut rates. The Fed has to cut rates to reaccelerate this stock market. Does stock buybacks do anything to promote the economy? They can, not directly, but stock buybacks basically makes shares more scarce. And if the company's value increases, then they can leverage more, they can finance more. And if they can finance more, then they can expand. And if they can expand, then they can increase employment. And if they increase employment, then you have stronger employment. So yes, buybacks can promote the economy, but it's not a direct promotion. They have to execute. They actually have to expand. If they just do share buybacks and they don't expand their company, they don't actually expand production, then no, it doesn't hit the economy. So it just depends what the company who does share buybacks actually does. Right. Right. So right now, yeah, TLT, I think we might come back on TLT. We'll see how this plays out. Gold is down. See where gold's at. Gold is down. Oil, I'm really keeping my eye on oil. If oil can remain subdued at the lows, okay, if oil stays down here at 72, then that, oil's giving us the signal that the war is not reaccelerating. I don't see anything yet on the news. I could be missing it, but we just don't want oil to spike. If oil stays down here, the Fed can cut rates because inflation is going to tank. I'm telling you right now, inflation will tank. The Fed funds rate's at 5.5%. Inflation PCE is at 2.6. So we're 2.5 points in the restrictive zone for inflation. The Fed has to cut rates. They just don't want to cut too early because of risks like this. But this risk is deflationary. A deleveraging event is deflationary, and inflation goes lower. I'm telling you, the Fed is going to have to cut or increase liquidity. We'll see which one it is. What is this? All right, we'll listen to a couple people talking about the Fed's path here. We'll get some more opinions, get some more input on that. Steve Leisman, I'm going to throw this back up so we can listen to what he's talking about at the moment. All right.
Jobs report. Steve Leisman caught up with Chicago Fed President Austin Goolsbee, joins us now with more. And Austin, Mr. Goolsbee really had the opportunity this morning, Steve, to sort of knock a bit of volatility out of this market, and it didn't quite work.
It's interesting you say that, Melissa, because the first thing I'm going to tell you is he did not. Austin Goolsbee, that is.
Hey, Carbides, you said, is this a reason for the Fed to pivot? Yeah, I think so. I don't know when they do, but I think the Fed will pivot, and it's going to be either increase liquidity into financial markets to plug up anything breaking, or it's going to be cut 25 basis points, cut 50 basis points. Do they do it today? Probably not. But the Fed has to ease financial conditions. If things continue to be tight, the collateral of the system is at risk. Everything blows up. If this continues, everything blows up. The collateral's at risk, and the Fed is going to need to cut. They're going to need to cut rates to ease the tightness of market. Look, inflation, forward-looking inflation is dead at this point. You're not going to get inflation unless the war kicks up and you get energy inflation, but that's just going to cause a recession. So we'll see. So yeah, Fed pivot for sure. Do you stock buyback? Okay, let's keep going.
Wouldn't take anything off the table, actually. Here's what he said when I asked him about the possibility of an emergency rate cut, which would come between meetings.
The Fed's job is very straightforward. Maximize employment, stabilize prices, and maintain financial stability. That's what we're going to do. We're forward-looking about it. And so if the conditions collectively start coming in that on the through line, there's deterioration on any of those parts, we're going to fix it.
Didn't say there would be one, didn't say there wouldn't be one. Markets are trading with something like a 1 in 3 chance plus or minus of an intermediate cut, but they've priced in definitively a very aggressive path for the Federal Reserve in the months ahead. Take a look, 150 basis points are now priced in through January, a 50 in September, priced in, 50 in November, priced in, and then 2 more 25s in December and January. It actually goes further than that.
Okay, so right now, September, 50 basis points. That's the highest. The market is now saying, look, you better cut in September. You better cut at the next meeting. We have Jackson Hole, August 21st. That is another Fed meeting where the Fed members meet up. They might be tossing up cuts at that meeting, August 21st. So this could turn around. We'll see. I mean, markets are crushed right now. This is a very oversold territory. We have to recover before we price in anything worse. Well, who knows? So 50 basis points, 25 in December, and then 25 in January. So the rate cuts are coming. We just, they could happen quickly, and it might be dragged out. Emergency conference, 50 basis points. You think so? Did they announce that?
But you have to cut it off someplace. Total of 150 basis points over the next 4 meetings. Goolsbee didn't comment directly on those numbers, but he did say markets could have made up its mind faster about a recession and what the Fed's going to do than the Fed itself has. He noted that the jobs report, it can be revised substantially, and that payroll growth did not yet look to him recessionary.
If you look at how the market reacts in its predictions of the Fed funds rate, there's a massively more volatility in the market reaction on a day-to-day basis than in what the actual moves are.
Worth remembering earlier last week, most forecasters were looking for 2% growth this quarter, and this year the jobs report was weak, and there could be further weakness ahead. But up until the jobs report, other data pointed to trend growth, not a recession. And Melissa, that ISM, it's not the strongest ISM services we've seen, but it's not below 50, and it seemed to be quite a bit stronger. It did not look recessionary to me.
Steve, yeah.
So that was Fed Goolsbee. Right now, the market's going to be wanting to look how the Fed responds to this. Are they going to suggest that we do cut, or are they going to stay hard? Are they going to stay tight? If they stay tight in their language, the market's not going to like that, because the market's like, hey, yo, give us some certainty here. The market wants certainty. And if the Fed does not give that certainty that, hey, look, we are now looking at easing policy, they're going to have to say it in a way that doesn't give it away. Then they're going to, we're focused on the communication of the Fed. What is it going to be? Where do they lean to? So we'll keep our eyes on that.
Well, but it had an impact, as you point out, as well on yields, which seem to have sort of given us a little bit of a pause in the selling, well off our lows in the equity markets. Steve, there's talk about an emergency meeting and a rate cut. I'm just curious to get your opinion. First of all, I'm sure I don't know how you feel about the possibility of it, though I could guess. But if it were to happen, just to say, would that be seen positively or negatively by the market?
In the absence of any further data, it would be seen negatively. And I think that's an important qualification, David, because look, the market sees pretty much what the Fed sees. They don't come to the same conclusion, but they see pretty much the same data. I do not see the data that would justify for me the Federal Reserve meeting on an inter-meeting basis and reducing rates. You have the jobs report, as Goolsbee said, there's a lot of trouble with that jobs report on a month-to-month basis. It would not be unusual to have one outlier that would be weaker than otherwise would have been. The unemployment rate had other factors in it. I'm sure the Fed is going to wait. In fact, I think we have a full screen, guys, of the stuff they might want to be looking at in the next couple of weeks. Watch your jobless claims on Thursday. If they start to blow out, that's something to watch. You have retail sales on the 15th. You have the JOLTS report coming up on the 4th. Income and spending. Those are all the sort of things the Fed is going to.
All right, so jobless claims, we'll see if those actually reaccelerate. Look, the other thing is there is a hurricane right in Florida. You already had the other hurricane in Houston, I believe. So that's going to spike jobless claims and unemployment a little bit. Is it systemic? Not necessarily. It's just a small delay. It's not a reflection of the real economy rolling over. It's more so going to increase unemployment and jobless claims on the data, but it's not a systemic thing. It will slow down the economy. It will slow down employment. That might get the Fed to cut also, right? Retail sales are going to be more important. Our retail sales, industrial production. This is total sales of, most retail sales is mostly consumer spending. What is it going to look like? Are we going to have, we're going to come in line, and industrial production is mostly like GDP is a combination of everything sold and everything produced. So industrial production is the production. Are we increasing production? We need this to increase because it lowers inflation. The more you produce, the more supply. The more supply, the less inflation pressure. So this needs to increase for the economy to really strengthen and, be a little more healthy here. Retail sales probably slow. Then you got income, JOLTS. We'll see how this plays out. But the Fed has a lot to look at now going forward. See what else. Let's speed this up. I want to hear what this guy has to say.
5 minutes of trading. So that gives you an idea of the volume challenges that these platforms will be facing today, as so many people are so active on a summer day.
Yeah. I know it's August, although we do get days like this in August.
It's true. It's true.
It feels that way
Yeah.
to me. Typically, I'm on vacation. Sadly, not today. Although happy to be here with you. So thank you.
Same here.
Yes. All right, let's get to our next guest as well. We're happy to have him. He says, believe it or not, this is normal, a classic overreaction to macro data, and shouldn't be a surprise. BMO Capital Markets Chief Investment Strategist Brian Belsky, his S&P target 5,600. Brian, why? Our viewers know you've been bullish typically, often right to be bullish. Why do you continue to feel that way?
Well, thanks so much for having us. I think what's going on in the market right now is a microcosm to what's going on in society. We want to react first. It's kind of fire, aim, ready. And I think about the talking heads when they used to say, same as it ever was, same as it ever was. So I have the very good fortune of doing this business for a long time. It's my 35th year. And I remember August of 1990. when Iraq invaded Kuwait, and my boss at the time, William O'Neill, thought we were going into recession. 6 months later, the market was rallying again. You remember the 90s, David, when I was on your network for the very first time in 97, 98, 99, 2000, 2001, 5 straight years in a row that the month of August was down. People are going to hate to hear this, but this is pretty normal. And it's part of a broader trend that we've talked about now for several months, that the markets in general are heading into normalization. Now, we said 9 months ago in our report for 2024 that the average correction during the second year of a bull market is 9.4%. We've been waiting for this. And so we do not like it when markets go down. We do not like it when people lose money, but this is normal. And I think a lot of investors have been reared through this notion of stocks only go up if interest rates go down. And we're transitioning again to this notion that bad news is bad news. And over the weekend, this is pretty classic. You have a terrible Friday. You have fears exacerbating over the weekend. You have a terrible Asian market. And then you have this rebound here from the lows already here today, Monday. So we're buyers. We're longer-term investors.
Brian, what are you buyers of? I asked that question because, of course, even previous to this recent downturn, we saw this significant rotation out of the mega cap names, for example, that had been a key.
And look, just to keep it real here, what are you a buyer of? There's a couple trades here, and I'm guessing he's going to call it. I'm going to guess he says he still likes tech at these levels, but he wants to let things kind of, resolve themselves. Utilities are still going to do good in recession. Utilities still go higher because everybody has to pay their bills, right? Their energy costs, your utility costs. Plus, there's the giant wave of capital expenditure or operational spending from the big, from big tech to generate AI. So as long as they continue to spend, utilities are going to look good. I like CEG. It is the biggest, it's the best chart in the market. CEG, it's like Constellation Energy. You guys have probably saw me talking about it for a while. It is pulling back at the moment. We'll take a look at that chart. I want to hear what he says though, and then we're going to go over some of the, some of the names you might want to buy down here. I think if you haven't bought anything, it's juicy. It's juicy. I still like crypto. I'm getting crushed on crypto. Don't get me wrong, but I still like crypto. I still like a lot of the, copper is looking good. Robinhood is getting crushed. A lot of these names are going to be oversold, and after October, they're going to be much higher than this unless the war persists.
Of significant outperformance for some period of time. So, what do you advise people to buy?
So from a positioning standpoint, our theme has been own a little bit of everything this year, meaning we've been provided a gift of this oversold nature for the last 10 years of small mid-cap stocks. I think from a fundamental perspective, they're the best position assets for the next 10 years. Value stocks again, and own some what we like to call the consumer staples tech. You've been provided a gift here the last couple of days in terms of your Amazons, Apples, Googles, Microsoft's Apple. You absolutely positively have to have exposure to these names. Now, these names obviously got too cocky on the upside with respect to their valuations, and now they've been humbled. Everybody needs a little humility in their life, and we've seen that in these names. We believe that is short-term and reactionary to be chasing consumer staples and utilities now, because especially consumer staples, David, these are very, very expensive names. If you do a relative PEG ratio compared to technology, they're not earning on an absolute basis what technology is. So let's take a step back. Christmas comes early, and Christmas is today, and we should be positioning accordingly for the next 3 to 5 years, which benefit U.S. and North American names, and you've got a great opportunity right now.
Are you pounding the table, Brian? Is this the equivalent of Belsky pounding the table because this is such an amazing opportunity with the backdrop of your price target?
Well, even this morning, Melissa, thank you so much. Great to hear your voice. Even this morning, this I would call it hullabaloo with respect to we're going to have an emergency cut. We are not in a recession. We do not have a declining economy. And in fact, the more people you have on today, economists especially, or bears that say we're in a recession, the more bullish I get, because that's emotional, and they've missed the big bull move, so now they're going to jump on the bear move. That's not investing, Melissa. So yeah, Bels keeps pounding the table because I'm a long-term investor. I think stocks are at new highs by year end. I think the next 3 to 5 years is all about quality and all about U.S. markets, and everything goes up together, meaning small mid cap. We revert a recession this time.
Okay, so he's pretty much bullish on everything. We'll go over a couple of those names. Let's see who else we got to pay attention to. VIX index. Okay, earnings growth. All right. Yeah, the S&P should be up by the end of the year. I mean, this was the only, yes, we're not really, like, here's the thing about the unemployment, report that we just saw. Here's the thing. It did look bad, but a lot of that was, again, like I said, it wasn't purely systemic. A lot of it was the hurricane, and people didn't, they're not working because of the hurricane in Houston. Now there's another hurricane in Florida. That doesn't threaten the the whole U.S. economy. That just, increases jobless claims and unemployment in those areas, right? Specifically. So also the labor force participation, more people are actually coming into the labor force. That's not that's a good thing. That means more supply of workers, and they have more jobs, they can spend more. So that's also a good thing. And we're not really in a recession. GDP actually climbed. I made a video about that yesterday. GDP is actually up. GDP is still climbing. It's stronger this quarter, which is the second half, which was what April, May, June, was stronger than January, February, March. So GDP is now reaccelerating again. And the last half of the year is usually the strongest because you have a lot of spending for holiday season. We called the holiday Santa Claus rally last year. So I think growth isn't really falling off, but you have a financial threat here. You have a deleveraging event. And the Fed might cut rates if that threatens any U.S. banks. If any U.S. banks were borrowing from Japan and now have to unwind, then we might get rate cuts for that, just because those banks are going to be holding deposits for customers, and not just customers, like, regular people, but they're going to be holding deposits for businesses. And if those businesses, their deposits are at risk, you're going to have to inject liquidity. So we'll see how that plays out. So somebody said, is there any good utility plays? CEG is what I like. I'm watching CEG right now. Constellation Brand Corporation. We'll take a look at the long-term chart. Let's just go ahead and hit the stuff that I have in play. Now everything got wrecked, so it's not going to be easy to, all the charts basically changed on us here. Oh, this is oil. We don't want to look at oil. So let's go through some of these names. I'm short Walmart. Let's see if Walmart's getting crushed. There we go. If Carbides is in there, we've been short Walmart since this move right here. We've been short Walmart. So we'll see. But yeah, CEG. So let's just go through the chart really quick. Short Walmart, long TLT. We're getting that pullback, but the thing is we're overextended on TLT, right? My guess is we reached like 105. We should continue to accelerate as long as things slow down. This might, the report that just came out showed that services were strong. So maybe TLT doesn't go up as fast, but I'm still long on TLT because the Fed is going to cut rates at least by September. IWM got absolutely crushed. We're waiting for this to pull back. We'll see how that plays out. ELF getting crushed, starting to bounce a little bit, but these aren't the secular plays. The real play here is that the Fed cuts rates. KRE should continue to squeeze higher, has a large short interest. A lot of people are short. Is Chainlink still the move for crypto? In my view, yes. I mean, honestly, if I make some big money on the VIX here, I'm going to buy more Link down at those prices. I wish I had more cash. You know me, I was pretty much all in on Chainlink. I'm still up on Chainlink. Chainlink's technology is trying to prevent these type of crises from happening. So it's very early, but I'm still bullish on Chainlink. All right, so KRE. Why KRE? Because the Fed cuts rates, the interest margins goes up. The people, basically the shorts get squeezed here, and they can now start doing more financing because rates are lower. I think mortgage rates fell by a whole point, right? So now there's going to be a lot more pending home sales. There's going to be a lot more mortgage activity. So that's going to help the regional banks also. I think they should all go higher, unless you have another tragic event. Then you have ITB, which is home construction. Let me just jump down to the actual trend here. Okay, so utilities, CEG, I like this one. This one's been very strong. Okay, and it sold off tremendously. We had the RSI reset all the way down here. I think on the weekly, we should have reset on the weekly RSI. Okay, we're halfway. So we're not all the way down there. As long as big tech bounces, honestly, once they come out with earnings, I think they should do well because all of the spending on electricity and the government also, right? They're in Virginia, and that's where all the data is for the CIA, right? All the CIA's data is in Virginia. So I like CEG. We'll see how things play out, but I like CEG. It's having a nice little bounce here. We'll see how it plays out. This is one utilities play that I do like. There's probably others. That's just the one I've been looking at. All right. On top of that, all this tech spending is going to go into copper. So copper is up a lot. There's two copper companies. There's Freeport McMoran. Okay. And they're in an uptrend. Copper is very oversold. I think it's going to bounce here. The global economy is picking up. Industrial production is picking up. Services are still picking up. More data centers are going to be putting in. You need more copper. Right? So you have FCX, ticker symbol FCX, and then SCCO, which is Southern Copper Corporation. I'm bullish here too. All right. Now I am getting crushed on these trades because I'm trading options on them, but I'm still positive that they end higher in the next 3 to 6 months. October is usually the bear market, the end of the bear market. Because of mutual funds, they basically can stop tax loss harvesting. So we'll see how that plays out. But I'm guessing October, that's the seasonal trend where you pretty much end in the downtrend. Amazon looks good also. But again, I wouldn't get too excited. I think the market's going to bid up and roll over again. All right. I don't want to see that, but I think we're going to bid up and roll over again. Okay. AMD. As a semiconductor play, I like AMD. Let's see where it's at on the weekly. Oh man, that almost brings us down all the way. So I like AMD also. The RSI and the weekly is almost reset. The last time we got this low on the RSI was literally, I know you guys can't see on TikTok. Go to YouTube if you want to see the full chart. I just can't keep moving this thing. So the RSI is almost fully reset on AMD. Does it have a better growth narrative than NVIDIA? No, but it still has a pretty strong narrative. NVIDIA, oh my goodness, NVIDIA finally oversold, got bought up pretty steep this morning. Again, I don't think this downside is over yet. I think there's more to come. There's going to be a lot of big institutions who are underwater, who on this big upside move, those who have been unexposed and underowned are now buying. And that's going to be an opportunity for people who are underwater to start selling. Okay, they're probably going to start selling up here. And that's what my expectation is. CrowdStrike's getting wrecked. Oh my goodness. This is still a good company. It just, it's going to have to tread some water for a while. I like Robinhood also. Still like Robinhood, almost fully reset. I mean, that thing is getting crushed. Look at that RSI all the way. That is extremely oversold for Robinhood. It did bounce this morning. If you caught it early, maybe you'd be good. And crypto is not going to disappear. There's a lot of deleveraging in crypto. I think a lot of ETH addresses just sold like hundreds of millions of ETH. So we might have further downside. My point is, I think the Fed has to do something, but until they come out and cut rates or, bring more confidence, at least confidence to the market, I think we're going to roll over again. Not any trading advice, no trading advice, none of that. I do like TLT though. I think TLT has nothing but upside. This is long bonds, right? You're long bonds. And why is that case? Well, when the Fed cuts interest rates, as the economy continues to weaken in certain areas, unemployment climbs and the Fed gets closer to cutting rates, people are going to pile into bonds. We had some tremendous bond inflows in the past couple of weeks in anticipation of recession. And if oil spikes, if the war takes on, people are going to buy more bonds. The only way that bonds really lose momentum, not just like they come down, they will retrace, but the only way that bonds don't continue this huge breakout is if inflation finds its way back, right? You need inflation to really come back. I don't see that happening anytime soon. So I think bonds are going much higher for longer. I like bonds. I like utilities. And I always like crypto, but it's not momentum. Right now, crypto is just a buy the dip. It's not necessarily a momentum to the upside. That's more of an investment, not necessarily a trade, but definitely bonds I think are going higher. This is a great opportunity to buy more. Oh, here we go. Slime Z. How's it going anyways? Hope everything's good. This is a great opportunity to buy more and look at a 10, 30-year time frame. Yeah, if you're young, sheesh, you should be buying the dip. If you're looking out years, 3 or 4 years, I would be buying the dip. Definitely. Okay, markets will be much higher into the future. This is just a deleveraging event. If you're a trader, you got to be careful here if you're trading, especially if you're leveraging options or margin. You definitely have to be careful here because the deleveraging event is on. Deleverage event is on, but that's what I like. Home Depot doesn't look too bad. Caterpillar, oh my goodness, got crushed. All right, let's get back to. Oh, let's straighten that out. Okay, there we go. Looks like TikTok crushed me for showing that video. That's fine. I'll just reset TikTok. I'm going to reset TikTok and bring it back on. Okay? Just so you guys know, if you're on TikTok, I'm going to reset and come back on.
Today, I've seen $120 expected move from the mid prices. Could I just take
All right, so we got CG starting to rip higher. SPY. Let's go to the SPY, see what it's trying to do here. All right, I'm just not going to show that video because that killed my algorithm.
The other problem is the valuations. Everywhere. That read it all for really striking. Yes.
And we will find.
Okay, they're talking about nothing on there. I see you, Slime Z. Oh, okay. I see you. Hey, at least you know how to invest, Slime Z. I wish I was informed about that when I was younger. Definitely wasn't. Okay, we're back on here. Yeah, keep up the hard work. Stay focused, man. Make sure you have a goal in mind. And you have something you want to achieve. Put yourself around the right people for sure. But you're young. You have a lot of time, man. I think Chainlink Chainlink's still one of the biggest opportunities that nobody sees. Might take years. It's going to take years. It's going to take time, right? These things take time. But this is the type of stuff that it protects against. All right, I'm going to shut down the Instagram live. I think Instagram shuts off after an hour anyway. For some reason, I don't know why. They changed the rules. Okay, we're going to cut that off. SPY still bidding up here. Yeah, remove that. We don't need that. They're talking about Bitcoin now. See if anything.
Spot ETFs for both Bitcoin and Ether. These funds have seen tens of billions of dollars in flows since launching, and they brought new traders into the market, with Morgan Stanley reportedly allowing its 15,000 financial advisors to start pitching Bitcoin ETFs to its clients starting this Wednesday. There's a big question about risk appetite.
Look, the VIX is just leaking lower.
Fourthly, Melissa?
Mackenzie, thank you. Mackenzie Segalos. Let's take a look at the average rate on a 30-year mortgage. Holding on.
There you go. 30-year mortgage rates falling.
The year as hopes of a September rate cut grow. Let's get to Diana Oleg with the very latest.
Okay, 30-year. Let's hear what this lady's saying. Hold on, I want to hear what she says about 30-year mortgages.
The one thing they're hearing today, right, Melissa? Look, rates are falling hard and fast. They came down all of last week, most sharply on Friday, and they will likely be even lower today. Last week, the average 30-year fix went from 6.81% Monday to 6.4%.
Yeah, so 30-year mortgage rates are, falling. That's going to generate housing activity. All right, that's going to generate housing activity. Let's go to the 30-year rate really quick. I know I got it on here somewhere. There it is, 30-year. Look at the 30-year. I mean, this isn't a direct, it's not a direct, mortgage rate indicator, but mortgage rates are dropping. That is going to stimulate economic activity in the housing sector, right? And all you can think of is going forward, as these rates fall, more people are going to come in and finance. That's going to create more construction jobs. That's going to generate, more people going to Home Depot. That's why I'm bullish on home builders and anything that has to do with homes, right? Pretty bullish on. So not like super crypto bullish, but they should be generating more revenues, more earnings, and that trade has been very depressed for a while. So it looks like, you know, this is bringing down mortgage rates. So there's always a bull market somewhere. There's definitely always a bull market somewhere.
Friday. That's the lowest level since early May of 2023. The recent high was 7.52% in late April, and home sales have been falling ever since. Buyers were battling not just high interest rates, but also high home prices and a lack of supply. Supply has improved a little, but prices are still overheated. But take a look at the difference. In just a few months, it is stark when it comes to affordability.
Oh, wow. So over the last, since April, okay, just looking at those mortgage rates. So if you go to that 30-year mortgage, we're just talking about housing activity and the economy coming back. The drop in these rates ever since unemployment weakened and rates really just fell off a cliff, or treasury rates. The average home price from now that rates are lower, the average home price in April was $2,240, $2,240. Today it's $2,000. So homes are becoming cheaper to finance. That's going to stimulate more housing activity, more revenues, more credit, and we'll find out how that plays out.
Buy a $400,000 home with a 20% down payment and a 30-year fixed mortgage would have been facing a monthly payment of.
That's exactly what the Fed wanted to see. The Fed wants to see the bond market really ease conditions. Right? This is a rate cut. Right? Everybody's waiting for the Fed to cut 25 basis points. But if you go to July, I don't know if you guys can hear me because that other sound is on. But if you go to July, 30-year mortgages were at 4.5. So a 25 basis point cut would be right here. We've basically had a 50 basis point cut for rates. Basically, the bond market is cutting for the Fed. 2-year dropped even further. Oh, that's what I wanted to look at, the MOVE index. Okay, this is bond volatility. This is the VIX for bonds. We don't want to see this go up. It's still low, but we don't want to see bond volatility go up because that is the collateral for lending and borrowing. And as long as that vol goes up, it's a reflection that there's a lack of liquidity. We want this lower. We don't want a lack of liquidity in the bond market because then interest rates will go right back up. Bond volatility, also triple B spreads. Are we getting any kind of risk to the credit market? We're going to look at triple B spreads. How wide is this? The market internals really quick. Market internals. Let's see. So no, that's industrials. What am I doing? Internals. Where is it? There it is. Okay, let's take a look here. So how many stocks are trading above their 50-day moving average? We're now down to 55. Okay, that's expected. Triple B spreads. Now these are starting to rise. This is the risk of basically the risk of equity credit. So when this rises, it tells us, make it a little more clear so we can see. When this starts to rise, it's basically telling us that people are piling into bonds faster than U.S. equity debt. Okay, these are financial crises. When you get this, there's some type of crisis when it spikes. It's not really at a level of concern yet, but it is rising. So this is signaling to the Fed, hey, you need to cut rates or you need to ease financial conditions. You need to ease financial conditions. That's what we're seeing there. Put to call ratio. Okay, puts are up a lot. We might be near the bottom just because the VIX is so high. Puts are so high. If the war does not reaccelerate and somehow nothing deleverages and there's no more deleveraging in Japan, we should be good. But I still think we're going to go lower. I still think we go lower. There's just so much uncertainty and a lot of people want to get out. They want to get out until things are a little more certain. They're probably going to wait for the election or wait for November or October. That's my guess. If S&P or the Qs go up too fast, my plan is to short the Qs. If they move up rapidly, I am going to short the Qs. That's my plan, at least. We'll see how it actually plays out. Maybe not if the Fed comes out. It depends what pushes the S&P higher. Let's go to, where's my macro stuff? Okay, let's get back to our regular candles here. Okay, oil. This is a good sign though, man. We're getting oil, roll over. Really good sign. Actually, let's go to this chart. What am I doing? We're getting oil start to roll over finally. Okay, and that eliminates the risk of an energy shock. I think this pretty much, I want to say it kills inflation. Okay, you're not going to get an energy shock if this continues lower. So that war is another risk. Still a lot of uncertainty here. Hopefully it doesn't spike. Hopefully we stay low. You want lower gasoline prices. Interest rates are lower. That's stimulating housing and mortgage activity. It's also going to help out small caps and regional banks and home builders, right? It's going to help out any interest rate sensitive sectors, cyclicals, all that stuff. So that's good. The dollar's down. Well, but the dollar's not down for a good reason. I did mention if the dollar breaks, it should be good for crypto. But the dollar breaking is a result of Japan increasing rates and strengthening their currency. It's not really, there's two ways that the dollar drops. Either another currency strengthens against it because the central bank increases rates, or the US Fed, who controls the dollar pretty much, or the supply of dollars, right? The Fed controls the supply of dollars, the liquidity. If they increase liquidity and cut rates, that brings the dollar lower. So there's different ways the dollar comes lower, and it looks like we're coming lower based off of the Japanese strengthening their currency. But it's not a bad sign. If the dollar was spiking, I'd be a lot more worried, because that would be people going into dollars and probably really selling all their assets. Tesla's getting whooped at the moment. What else we got here? Oh, Chainlink's getting, oh my goodness. I wish I had more cash. I would have bought Chainlink at $8. Are you kidding me? This thing came all the way back down to where it was in October. I remember this move, October of 2023. That's the risk you take on risk assets. That thing's getting smashed. No good. Okay, let's do a little bit of TA here for the S&P. Where could it be headed, right? If we do let's do the fib. Actually, no, let's do anchored VWAP. We already got crushed on this anchored VWAP. Let's take the volume weighted average from the previous low. And maybe we have a little more downside. Maybe we come to 5,000 for the S&P. I think we could definitely move up first and then sell off. I don't know. Nobody can tell. But it doesn't look like the S&P has enough strength to really break out of this trend. This is a nasty, this is so steep. This is just so steep though. So steep. So that's your anchored VWAP. Maybe it's coming into this one. Let's see. Just about. I'd still go back to last year. This was last October where we bottomed out. That's kind of where we're headed. Last October, around 5,000. That's just one data point. That's one way to look at it. Let's use the Fibonacci. And I don't even think any of these matter because it's a macro. It's really a macro risk. Okay, so golden pocket got way beneath that. Well, that's treacherous if we came all the way down to 437. We'll see. Nobody knows. Nobody knows. Nobody knows. We need more clarity. It's a lot of misconception. I do like to look at oil, though. I like to look at oil and the dollar and interest rates. How about that 50% retracement? Are we near that? If we go from that last low, 50% would take us down here to 4,800. I know a lot of people are calling for 4,800 on the SPYs, 5,000, 4,800. We probably retest this trend and then roll over. If we do see those numbers, probably going to look like this. Maybe we come down one more tomorrow. We come back, retest it, boom, and then drop again. And then going into October, then we go higher. Right? We need some more clarity, though. We don't know what's going to happen yet. We need a lot more clarity. Hey, check out the newsletter. If you guys are new here, check out the newsletter. It's free. It is in the link in the description. If you're on YouTube, I actually haven't added it to YouTube, but we do have a newsletter that comes out every month, once a month, twice a month, sometimes 3 times a month, just depending on what news hits. I think the last one is about interest rate cuts, and we're building a course also so you can learn macro, right? To give you a big picture of the market, to understand the internals. This is all a macro move. I know a couple dudes who are asking, hey, what are the technicals? Where do I buy the dip? And I said, hey, look, this is macro risk. Okay. Technicals do not matter when the macro is at risk. And the biggest macro at risk right now is a deleveraging event. It is also a war, but the war itself is not what causes stocks to sell off. What causes stock, as a matter of fact, what does LMT look, or what is Lockheed Martin looking like? Is this thing really bidding up? Oh my goodness. It is. Okay. So you always have a bull market somewhere. You got Lockheed Martin moving up, probably some other defense names, Raytheon, who knows. But anyways, yeah, the real risk is that if oil spikes, it's going to cause a global recession and it might cause stagflation. I don't think it happens, but it's still a risk that the market wants to price in. And the VIX, let's talk about the VIX a little bit. The VIX is in complete panic mode, right? It's probably coming back down to 20 at some point. And this is the spot that we got to watch. When it comes to 20, maybe it doesn't happen until mid-October or mid-August, who knows? But when the VIX finally comes down here, if it bounces higher, not good. We're still in a very high risk-off zone. You want to see the VIX come and just break below 20, maybe come back up, and then drop again. When you get in this 20 zone, below the 20 zone, we're back into confidence mode. We're back into the uptrend. Okay, we're back into a bull market. Under 15, oh, we're definitely trending higher. Under 15. We're back into the bull market for sure. But right now, this is all screaming sideways action / bear market. Sideways / bear market. Depends on how bad it gets. So the VIX has certain levels to it. And you definitely want to pay attention to the VIX. If you're an options trader, then you're going to get so much premium from the VIX being elevated, a lot of premium, but you might get destroyed if you make the wrong trade, because the VIX also implies that the move in the S&P is a lot bigger. Now, let's say the S&P moves on average about 5 points a day. When you go from 20 to 26, okay, that's a standard deviation that's one magnitude bigger, meaning instead of from 5 at 20, you're looking at a $5 move on average. If it goes to 26, you're looking at a $10 move. Okay, you're looking at a $10 move, much bigger. Up here, you're looking at an even bigger move. So I'm surprised the S&P hasn't really broke anyway yet. 510 to 5. Well, we just moved 10 points. Yeah, we just moved 10 points, right, from the open. So that makes sense. That does make sense. We moved 10 points from the open. Even more if you count the low. So that was a big move. I don't know if the S&P can hold this though. We'll see. It's holding so far. What does the Fed have to say? That's the question. Any more questions about this carry trade? Let's go ahead and take this off. Fed net liquidity. We need Fed net liquidity. Uh-oh, TLT starting to pick up a bit. This is a recession trade right here. Best brokerage for stocks? It's just relative. There's not a best broker. There's just the one that's easiest for you depending on where you're at. Oh yeah, Buffett sold all his Apple. Pretty good move. He probably knew that carry trade was happening. That Apple, the carry trade from Japan. And yeah, I mean, Buffett sold a lot. He's raising a lot of cash. I think a lot of people really just want rate cuts. They want to see rate cuts so they have confidence that the economy it can reaccelerate. Is it going to dip even lower? Probably. I think it goes higher first, which it has. We're already up 2.5%. And if we don't, so here's pretty much, just so you know, on the S&P, this is pretty much where we opened. We opened somewhere around here. We're at the open. And it's game time right here. If the S&P gets above this range, then we probably fill that gap. Big panic. But I think if we do fill the gap, we roll over again. If we can't, we're going lower. But the lower we go, the more likelihood that we bounce sharp. look out for the. I'm just gonna call it now. It's hard to call markets, but we should see a sharp. I mean, this is a sharp recovery, but we're probably gonna get a sharp recovery soon. Let me go to the 30-minute chart. We're probably gonna get a really sharp recovery. And my guess would be this is a 30-minute chart. Let's go to the 4-hour. Let's go to the 4-hour chart. My guess would be that we have a sharp recovery. Here's our last. I mean, maybe this is it. Now, we might have a really sharp recovery in the S&P and the Qs, maybe the S&P more so, back to like 530, 525. And then I'll be looking for the rollover again. See what the Qs look like. Yeah, recovery and then rollover. Nobody knows if we go lower, but it's more of like a day-to-day basis. But I think we can definitely go lower, especially if the U.S. gets dragged into the war. I think we're going to finish off here. We're at an hour and 20 minutes, unless anybody else has questions. Did Japan recover? The Japanese Nikkei. What is the Nikkei? I don't even know what the Nikkei is, what the ticker is. They're trying to recover, but there might be some more downside. Usually give it about 3 to 5 days. You hope Rivian can recover. Yeah, Rivian's getting smacked. So typically you have 3 risks here for the market. All right, let's talk about these risks really quick. Here's the Qs. You have 3 risks. Number 1. Okay, so number 1 risk, you have the deleveraging event continues. Okay, so you get more deleveraging. And that deleveraging probably happens up here somewhere, right? You're down like 60%, 50%, especially if you're borrowing on margin, and then you see your account recover, and you're like, let me just cap the losses. I don't know what's going to happen next. So you got more deleveraging, number 1. I think that's a huge risk. Number 2, you get U.S. gets dragged into Middle East. Okay, U.S. gets dragged into the Middle East, like actually dragged into the Middle East, not just sending weapons and sending whatever, sending weapons and money or whatever it is that we send to them. We probably send all kinds of stuff, but we actually get dragged into the Middle Eastern war. Hezbollah is a lot bigger than Hamas, right? Iran, who knows how they're going to respond. So those are big risks there. You have political risks, right? You have let's call it election risks. Election risk. Man, I can't even. You have election risk because Trump and Kamala Harris are gonna definitely be. They're not gonna look at things the same way. Who knows if Kamala Harris? We don't know what Kamala Harris is going to do. I think the market is more concerned about what she does because of the big taxes and corporate greed, is what they talk about. Trump is definitely better for the economy and the stock market. Historically, that's been true. And I think that's the big risk with the election. And then who knows how they handle geopolitics, right? We just don't know. Those are our big risks there. More deleveraging from Japan, not literally from Japan, but from the Japan carry trade. U.S. gets dragged in the Middle East, which causes the dollar to go up and oil to go up. Not good. Puts us into recession. You also have policy risk, right? If the Fed does not cut in time, then they might just wait for something just broke. They got to do something, but you have policy risk. The Fed's going to have to make a choice. They got to increase liquidity, increase money supply. They control the supply of money, or they cut interest rates. If they do nothing for too long, the market's going to get very worried. It's pricing in cuts even faster. Markets are all about expectations and surprises. If you get a good surprise, markets go up. If you get a bad surprise, like we just did, markets go down. What are my thoughts on Intel? I mean, I think Intel is just, I know it's down a lot, but I wouldn't bet on Intel. Intel hasn't done nothing for years. I never liked it. And, they just can't compete. whatever it is, they just can't compete with AMD and Nvidia. You could try to buy the dip here, but I know people are like, oh, it's down a lot, but you just never know if Intel will ever really break all-time highs. This was pandemic stimulus, right? I don't know if Intel is the best play here. And just think of it this way. If it recovers the all-time highs, that's a 250% return. That's a pretty big return, actually. It got crushed. 250%. I really doubt that's going to happen anytime soon. That might take 5 years. Too much. This is too much for Intel. Intel probably comes back here to like 30s at some point. But no, I think you're better off owning Nvidia. There's other chips out there. There's a whole, I got a whole section of chips. Let's see, where are the chips at? Where's our chips plays? ARM might be a better one too. Chips. There we go. I should just type it in, huh? So Nvidia, number one. Why? Because Nvidia has a damn monopoly. They just have a monopoly. They have a monopoly. Big bounce on Nvidia from 91 to 101. We'll see if they keep up. SMCI. I'm not a big fan of SMCI, but they probably have more momentum than Intel. Qualcomm, better than Intel for sure, in my view. Okay, Intel could recover. This could be a trade, though. I mean, Intel probably got oversold. It could be a trade, but to own it, I wouldn't want to own it. I'd rather own AMD. Okay, you also have Broadcom here, AVGO. Broadcom's a better play. TSM, I mean, solid play here. Unless, oh, that's the other risk we didn't talk about. You're forgetting a major semi-chip stock. Well, I didn't go through all of them yet, Anthony. NVTS. Oh, I didn't even have NVTS up there. What I didn't factor in is that I don't know if this is going to happen. I really hope it doesn't. But Taiwan was warning their people to prepare for an invasion. That would cause the VIX probably to go to freaking 100. Who knows? You don't want to see that. I really doubt that's the case. I don't know what that's about. I'd have to look into it further. But if China attacks Taiwan, or, you know, to try to get the, you know, the production, the supply of chips, that's going to be nasty. That's going to be a bear market for sure, in my view. You're looking at a bear market there. Definitely not good. ARM, I think this is Chinese. I'm not sure. Micron, I mean, Micron looks better. I just don't like Intel. That's just my view. I mean, maybe I'm missing something, but Intel probably can recover, but I don't think it really goes anywhere over the long term. Marvel on now. Now's a good one. So NVTS, who is this? Novartis. I wonder what this looks ugly though. Why does it look so? Are you trying to play me, bro? A major semi-chip stock. Is this really a major semi-chip stock? How big? What is the market cap? This looks more like a penny stock. Not to say they have no potential, but the market really isn't giving them a bid for a reason. When the chart looks this bad, there's usually a reason for it. So you definitely got to do your research on this. I wouldn't call it a major chip stock, though. I definitely wouldn't call it a major chip stock. I guess depending on how you define major. It has earnings today. Okay. We'll see how it plays out. Hopefully they do well. I hope you make money. But yeah, I just wouldn't call it a major chip stock. It probably has potential. Potential, right? But your major chip stocks are right here. This is the list of major chip stocks. And hey, if this thing pops, it has a lot of potential. Who knows if it ever does? You definitely have to do your research on that. We'll see what the earnings say. Maybe it's a play down the road. Who knows? Okay, what else we got here? Fortress Biotech, Artesian Networks, Lay's Chips. Oh, NVIDIA. NVIDIA is extremely oversold. Look, I think NVIDIA has one more dip. Okay, now that was a nasty dip. Listen, this could be it. This could be the bottom for everything. This could definitely be the bottom for everything. But what is the probability that the bottom is in? Maybe for individual stocks it is, but the overall indexes, I don't think the bottom's in yet. or at least I don't think the downside is in. Right? I don't think the downside is in yet. But Nvidia is solid, man. I mean, Nvidia is, people are really thinking Nvidia is some type of circus play. It's not. Nvidia, their earnings are tremendously ridiculous. They just priced in way, they went to 3 trillion. That's too much. They went up way too much. Now you're getting Nvidia down 33%, which is what, $500 billion. I mean, they've almost shed $500 billion in market cap. So they're back to where they were before the last earnings, right? That's fair. If you're trading it, that's, we don't even know what we're talking about. But I would wait here. Do not go buy Nvidia. Wait for the market to consolidate and show you a little more, maybe sideways consolidation. I don't know. We'll see. But today's information is basically, look, these are the risks. More deleveraging from Japan. A lot of people are borrowing from Japan. Okay. And now that Japan is hiking interest rates, their loans inflated because the value of the Japanese currency inflated. So they're underwater and they're paying higher interest. Therefore, they have to deleverage. They have to sell all their US assets, all their Japanese Nikkei assets, and they have to cover their debts. Now, we don't know how systemic this is. Does this continue? Does this fall into Europe? Does this go into the US banking system? Hopefully not. Unless you have a bunch of puts, you probably hope it does, right? And then the US being dragged into the Middle East. I don't know how, I don't have enough information to know what the probability of this is. Really don't. Election risks. Well, you just got to wait for that, right? You just got to wait for that. Policy risks. That's probably the most immediate thing that you're going to hear about. Is the Fed going to cut rates? Are they going to cut rates? Are they going to increase liquidity? Buy oil. If the war breaks out, oil would be a good trade. It would. But I don't know about that. Are you taking money from stocks and putting it in Bitcoin recovery? Oh, look, for me personally, I'm just giving general, not advice, but I'm just giving general thoughts on myself or on what I would do if I was you. But for me, oh man, I would be long crypto. I still think crypto will be the strongest play in the next 12 months, right? Maybe you layer it Bitcoin, Ethereum, Chainlink, Solana, who knows? But I still think crypto is the strongest trade. I don't think that's going to change. I think that is the strongest trade right now over the next 12 months, not over the next month or two, over the next 12 months, especially if Donald Trump leads in the polls and creates more pro-regulation for Bitcoin and crypto in general. Crypto's role is to reduce these type of risks from happening, these deleveraging events, because the current system is very flawed. Crypto system or a blockchain system is auditing these misconceptions or auditing these financial risks in real time. So you're not going to get these big blowouts, right? That's the difference between crypto. I think crypto is the big trade. It's taking a lot longer than I thought it would, but I still think it's the big trade. We'll see how things play out. People will take profits from crypto and buy stocks when they're low. Yeah, I mean, listen, if people are up on something and they see something low, they're probably going to rotate. They'll rotate. It'll happen. You're going to get rotations here and there and here. The question is, where's the big money headed? Where's big money headed? It was Nvidia. It's probably coming back into the chip sector. That's not changing. The infrastructure, there's a lot of infrastructure policy that's coming into play also. So there's just a lot of money in the system. Money market funds. As soon as the Fed starts cutting rates, money market funds come back. I mean, I'm sorry, not come back. Money market funds start to bleed into risk assets. So I really think it comes down to, when is the Fed gonna cut rates? Is the VIX up again? No, the VIX is down. The VIX is falling like a rock. Right? That was a very overly. We'll see where the VIX ends. I'm gonna finish with this. Watch the VIX. Okay, these are the levels for the VIX: 28 and 20. If the VIX bounces at 28, I believe, is it 20? Yeah, it is 28. I'm sorry, I said 26 earlier. It's 28. These are the magnitude of I don't even know how to say it. The standard deviation, the magnitude, the big moves from 20 to 28 is a gigantic change in volatility. From 28 to 36 is another big, holy smokes. We have actually, I should have marked that up. From 28 to 36 is another, it's every $8 for the VIX. And then from 36 to, what would that say, 42? So we just made a tremendous, I mean, we made the biggest jump in the VIX so quick. Wow. And then what, 52? So we got way up there. Holy smokes. Holy smokes. We had the biggest VIX jump in 3 years. I mean, this was the third largest spike in the VIX of all time. This is not technical analysis. It's just the VIX, like where the VIX has its standard deviations, like the way the options market prices the VIX, every $8 over 20 is extreme volatility. Uh-oh, it looks like it bumped up a little bit. I'm not a professional options trader, so I don't know how to like go into the terminology, but I just know every $8 the VIX, like once you get under 20, you're back into the bull market. Right now we're looking at a bear market slash correction slash sideways market. So we definitely want the VIX to cool off. Hopefully that was the top. Probably is. Doesn't mean markets can't go lower. They can still go lower with the VIX not making a new high. Thumbs up to you, man. You should know about do you trade options, Thumbs? If you trade options, you know what I'm talking about. If you don't, then I would understand why this looks silly to you. You could check out Tasty Trades. It's an options. It's probably the best options education there is. Tasty Trades. And they have a lot of content on how the VIX works with options. You made a lot of money on USDJPY. Yeah, so just watch the VIX. I mean, I'm not talking to everybody here, but the VIX is going to give us a lot of clarity also. Is the Fed going to come out? What are the risks to the market? Good luck on your trading, your investing. I mean, that's all for now. We'll keep you updated. Stay tuned. Subscribe to the channel. Get in on the newsletter if you want. We are building a course, a macroeconomic course, reading the business cycle, how the central banks work, all that stuff. So you guys stay tuned, and we'll catch you tomorrow. Stay blessed, work out, eat healthy, learn something new every day. Thank you guys.